What happens if you send a tweet or an email with a typo error? Well, you feel bad, perhaps reply with a sorry and also a correction. But in stock markets, a typo while trading can cost you crores of rupees. And what's worst, there may be no way to recover this loss. In fact, this has just recently happened in what could be the biggest trading mistake that has ever been witnessed in India is what has been seen in the first week of June 2022 in what is estimated to have been a loss of 200 to 250 crore rupees in a fat finger trade. So what exactly is this fat finger trade? Well, it is an erroneous trade due to punching a wrong key on the keyboard or by clicking the mouse at the wrong place. And this is what has exactly happened. For example, if a trader sells 1 lakh shares at 1010 rupees, but the market price is 1100 rupees, the result is a loss of 90 lakh rupees. In such a case, it could be a huge loss for the initiator, but a windfall gain for some other traders. So how did this incident happen? Let's get to understanding this. While NSE has not really made any official comment on it, it is reported that on June 2nd, 2022, the day of weekly expiry between 2:37 to 2:39 p.m., a trader inadvertently punched an intraday sell order for 25,000 contracts. That's 12.5 lakh shares on the illiquid deep in the money 14,500 Nifty call option expiring on June 2nd. The price of the option contract, remember there are 50 shares in a contract, was around 2,100 rupees per share. But since the trader quoted a much lower price, the share plunged from 2,100 rupees a share to as low as 15 paise in just a matter of minutes. Now, even though the trader tried to square off his position, he had to do it at a huge loss, estimated anywhere between 200 to 250 crore rupees. Well, after the incidents, NSE has really cautioned the stockbrokers against executing orders which appear to be non-genuine and leads to deviation from the normal price discovery process as well. But such fat finger trades have led to huge losses in the past as well, and not just in India, but in abroad as well. Well, this incident in fact brought back some memories of the 2012 fat finger trade as well that caused a 60 crore rupee loss to MK Global Trader and also led to a nearly 15% dip in the Nifty index. Well, some $600 billion inflated order for blue chips had also come into notice in Japan in the year 2014. In 2018, also a wrong transfer to some accounts of Deutsche Bank of about $28 billion was also reported. But how do these trades really get fixed? That's the bigger question. Well, some broking houses and exchanges have in-house system of filters to catch and stop such trades as well. Experts also believe that NSE also has put in place alarm systems when trades are executed at a much above or much below the prevailing price to sight out any erroneous trades. But however, no alarm was raised in this case by the exchange this time around. So another option that could be is that the parties involved here can also solve these issues among themselves. That also rarely quite happens because the one who has gain may also want to reap those gains. Now, some questions will need serious thought after this incident, both by brokers and the exchanges, to prevent any future instances like these, including to check if the seller had that much margin and were the limits not breached in this case. Also, the broker is supposed to have limits on orders and then double checks to prevent any fat finger trades as well. Why did those triggers not take place? Also, lastly, it is not clear why the exchange filter did not get triggered as well in such a case. While the NSE has put a trade or a trigger to identify any fat finger loss, why did those triggers not go off? Those are the questions that still remain unanswered and need a lot of thought-provoking discussions among the brokers and the stock exchanges, and even perhaps a look by the capital market regulator, SEBI, in this case too.
If you like the video, do like, comment, share and subscribe.